We've got bonds rallying, dollar down, stocks trying to take some cues post-inflation for a rally. Joining us, Joanne Bianco, investment strategist and client portfolio manager at Bond Blocks. Thanks for being here this morning, Joanne.
Thanks for having me again, Oliver.
Appreciate that. So tell me what you think about these numbers. Are they worth celebrating?
Well, yeah, core PCE came in around estimates today, so less than the advance last month. So definitely a step in the right direction. And, it's nice to see inflation not re-accelerating further from the hot numbers or the hotter than expected numbers earlier in the year. But rate cut predictions continue to be pushed out. They may not even happen at all in 2024. So at most, we envision probably one rate cut this year.
And this defined as progress in the Fed's eyes. I mean, if we're looking at the cuts, to your point, it kind of seems like a little bit of status quo, maybe.
Probably, yeah, but not something concerning for them. Probably progress.
Okay. So when you look at kind of the impact here, I mean, we did have a decent little sell-off in treasuries last couple weeks. Should this put a halt to that? Does it just slow it down? Tell me what you think about kind of the trajectory for bonds generally right now.
Yeah, no, it's kind of been a tale of two halves for the month of May with treasuries and also with fixed income performance. The market started out really strong and, with sharply rallying U.S. Treasury rates with the below expectation CPI and payroll numbers. But then, that's been followed by a reversion of most of the rate move during the second half of the month. And that was reflecting the weaker than expected 2, 5, and 7-year auctions by the Treasury, which the market viewed as concerning, considering the size of the deficit. But nonetheless, the performance of most sectors of fixed income ending the month of May in positive territory off their highs. In terms of where rates are now, yes, it does seem like we're not. We don't have a cause for re-acceleration in yields to higher levels with the information that we have right now.
Okay. So when you look at the potential cause of that, to your point, a few auctions that went a little awry there, what is that kind of breakdown in your mind of what's the main driving force? Like, are they kind of two in the same where the auctions go bad if rates are already kind of in hot water because of inflation? Or is there a scenario where the auctions can just be soft in general, kind of agnostic of what's happening, or are those two things sort of one and the same?
I think it's more the latter of what you just said there in terms of, like we can have better auctions and some that are softer. So I don't think we necessarily have a trend that's apparent from that yet. It's certainly something that affected markets this month.
One thing that I've been watching pretty closely as the bond price has, had some ups and downs, obviously, over the last 9 months, is that the curve, the tens and the twos, has basically been in the same range. I mean, the tens and the twos haven't really moved for like 9 months. What do you make of that, Joanne?
I don't necessarily know what to make of that.
Is that like Goldilocks? Is like as long as it doesn't move, are we good?
Yeah, that it could be described that way.
If you look at generally kind of where then that helps the overall investor and the portfolio manager, I mean, does that give us kind of confidence that maybe bonds work as stock hedge? Do you think we've moved on from that as an issue?
Yeah, we do think that. I mean, we do think that these elevated yields, these higher yields are attractive for investors, especially in specific areas. Like, for example, we're very constructive on corporate bonds, both BBB corporates, and then also selected sectors, credit rating categories in high yield, because we think that the still strong economy is very supportive of the fundamentals of the underlying corporations. And so it's something that makes us think that, you can do well by investing in corporates right now.
So what's that trade-off in your mind? What makes sense? Tell me more about that risk taking within credit. Should we just kind of go for where we get the biggest bang for the buck if the economy is not going to hit a wall, roll over, collapse?
Right. So in investment grade, we see no reason why you shouldn't be overweight triple B, the triple B corporate area of investment, the investment grade universe, because we think that the additional coupon income that you get from triple Bs will enhance your returns more than any other sector in investment grade. And then in high yield, there's reasons to go all the way down to triple C exposure, and if you have the ability to take on, more credit risk because you can get more like equity returns there.
That betrays generally a confidence in the economy, right? If you're willing to go down to that level of credit risk.
Yes,
Okay.
definitely.
So when we look at strategies, where do you see the money coming in? Where are the products that are getting the most attention? I mean, is it on that kind of higher risk credit side? People feeling confident that they can get some yield. I mean, you still get 4.5, in the Treasury too, which is not bad. Does that detract at all from the lower credit, higher, income case?
Yeah, that's not bad. The cash returns are still attractive, but why not enhance above that? We're in a market environment that there's ways to enhance your returns by taking on some more credit risk, but not that much more in the current environment.
Okay. Thinking about the kind of best parts then for treasuries, like if we're not going to have a big sell-off in bonds, if we are not going to have a big drop in rates either, though, if we're going to kind of like hover here, is that T-bill and chill trade back? Like I was talking to folks about just generally kind of locking it in. I hear a lot of that, especially kind of in the the near or after retirement crowd that just want to lock in the money. Does that make sense?
Right. Yeah. Short to intermediate term treasuries are where we think the most attractive parts of the curve. We're a little more hesitant to be long in long dated treasuries just because of the amount of volatility that they still would represent for investors. But there's definitely the short end, certainly for the high current income, the intermediate, and for basically, the fact that we could see lower rates probably within a year from now.
Okay, so that makes sense. That trade kind of works still a little bit. The higher risk, higher income trade works, moving down the credit spectrum. If you do that, to come back to that for a sec, where does that take you, Joanne? I mean, do you have to be digging through the discount bin into the beaten up sectors and themes, or how risky is it, do you think?
No, I mean, you're not having to go into the beaten up sectors. Really, the only really beaten up sector in high yield right now is TMT. And that's not an area that we would necessarily recommend overweighting because we think of the fundamental and challenges and headwinds for a lot of credits in the TMT sector means that, we would still be recommending an underweight there. But you're able to take advantage of these higher yields without focusing on the riskiest end of credit.
You guys' funds break down like literally each tranche, right? Like you can target
Right.
ticker XB, right? Like for B rated, then triple C for that. Like it's each tranche that you guys have.
Yes. It's just a great way of dialing up or dialing down your risk in high yield, picking the credit quality that you have, you're most interested in. And, I've called the single B sector the Goldilocks sector in high yield before because it's basically not the credit risk of triple C's, but a yield pickup from double Bs and also the broad high yield index. So it's just kind of it's to me that seems like a good area to invest in high yield too.
Got it. Okay. Hey, even though tax season passed, you guys also have a fund that particularly targets those being tax conscious. Tell me about that real quick. TAXX.
Yeah, so that fund is basically to focus on, it uses a combination of tax exempt and taxable bonds because there's more to tax aware investing than just investing in municipals. So it's about the after tax return that you're able to generate. So that's what we do with our tax ETF. It's managed by a very, very well-regarded sub-advisor, IR&M, that basically has a lot of money in this particular strategy. And so we've partnered with them, and it's something that enables investors to just take home more in terms of their after-tax return.
Okay, and a lot of munis, but not just munis. So I feel like a lot of the
Right. There's
tax.
corporates in there. There's, yes.
Got it. Because a lot of people, the tax advantage conversation is just munis, and then that's it, basically. So you guys throw a little extra spice in there. All right, thanks, Joanne. Appreciate the catch up and the walk through the
Thank
products that
you.
make sense.
Thank you for having me.
Absolutely. Thanks for being here on a Friday morning. Joanne Bianco, investment strategist, client portfolio manager at Bond Blocks. All right.